Gold and silver, two of the world's heavyweight commodities, always in the spotlight, always moving. Now their fame comes from a simple belief: these metals hold value. Now that belief fuels demand, and that demand fuels volatility. But there's a key metric that ties their prices together. A number traders watch like a heartbeat monitor: the gold-silver ratio. Now in this video, we're breaking down what the gold-silver ratio is, why it matters, and how you can put it to work in your trading. All right, let's do it.
The gold-silver ratio is a simple metric showing how many ounces of silver it takes to buy 1 troy ounce of gold. The idea is ancient. When gold and silver became legal tender around 700 BC and entered circulation through early Roman coinage, the relative value laid the foundation for what we now call the gold-silver ratio. It's one coin against another, one metal shadowing the other. Okay, let's get you set up to look at the gold-silver ratio on TradingView and on MT5. First, TradingView, simply go up to your search bar, type in gold-silver ratio, and you'll see the TVC, the TradingView feed, will give you an actual gold-silver ratio in real time. Now, if you don't want to use that indicator, you can certainly just go here and type in the XAU, XAG, which essentially is your spot gold to spot silver, and you'll notice that several data providers do give you live updates on that, so that's OANDA right there. Now, in MT5, it's a bit more involved. You'll have to be looking for some sort of expert advisor, maybe a third-party indicator, something like that, or you can just do this manually. And the way you would do that is just take your gold chart, look at the price of gold right up here, and divide it by your silver chart, the price of silver. That will give you a running total and an accurate look at your gold-silver ratio in real time. Okay, let's take a look at the actual calculation and what it really means. Now, the 20th century, a lot of gold trading, of course, 100-year period, but the average ratio there was 47-1. And the big thing to remember about these ratios is they move because of key events. Major events cause big swings in the gold-silver ratio. Great Depression was a big one in the 20th century. The Gold Standard Act of 1900 was a big one. In 1971, when the United States left the gold standard, that also sent ripples through the market. Now, for the 21st century, the last 25 years of history, COVID-19 was definitely the big outlier. That was the all-time high, right up around 126. So that's a key thing. Remember, huge events move this ratio. The reason why you saw such a big spike there was the price of gold definitely outpaced the price of silver, and because you're in a panic type of a situation. Now, the typical range over the past 25 years has been about 40 to 80. So if you're trading somewhere in that range, you could say you're within relatively normal bounds, although that average within that range will vary. Just a quick look at more recent price action here. In 2025, you'll notice that the big tariff crash of April 2025 made the price of gold really spike. It outpaced silver. As things normalized, you see this ratio come right back down into sort of its normal range, that 40 to 80 range. Okay, that's a good look at some of the historical data and a little bit about how to get set up on this ratio. All right, let's press on and learn a little bit more about why this is important.
The gold-silver ratio matters because it helps traders gauge when one metal is undervalued relative to the other. Now, it's a simple number that can signal real opportunities in the live market. Traders use the gold-silver ratio to time their buys and sells in precious metals. Some argue that it should mirror the metal's natural abundance in the Earth's crust, which is around 16-1, while others believe that the modern industrial demand for silver means silver should always tilt the ratio in its favor. Now, regardless of the debate, the gold-silver ratio has been tracked for thousands of years, and it continues to be a key tool for everyday traders and seasoned professionals alike.
All right, let's run through how you can trade the gold-silver ratio. Now, there is really no direct product where you can just trade the ratio. There are some spot pairs. Maybe the XAU, XAG would be a place to look. It really depends on your broker and what exactly they offer. More than likely, you're going to have to trade gold and silver separately in accordance with what you believe the ratio is going to do. So we're going to be looking for CFD products, spot market products, or futures products that face those two assets to get you up and running. So let's go over to our MT5 platform. You can see we've got the gold, the XAU USD, and the XAG USD. Spot market stuff, we're going to go ahead and trade one against the other to try to capitalize on fluctuations in the ratio. Now, this is relatively simple. Let's look at our prices right now and do just a quick offhand calculation. 4207, 5840. Our gold-silver ratio right now is somewhere in the neighborhood of 70-ish. Let's say I believe that's overvalued, and I think that ratio is going to come in. Now, what does that really mean? It means that the prices are going to converge. In order to execute that type of trade, it's relatively straightforward. All I'm going to do is sell gold, and I'm going to buy silver. Now, this puts me in a position to profit from falling gold prices and rising silver prices. And essentially, as that ratio comes in, as those prices sort of converge, that ratio is going to get smaller. That's going to help me profit. So that's one way that you could trade the ratio. Now, let's take a look at the other way that we could trade this thing. Now, let's say at 70, I believe that this thing is undervalued. I believe we're going to get back to what we saw maybe earlier in 2025, where we're up around 100, 115, 120. If I believe that, what should I be looking to do? I want to put myself in a position to get in on prices when they diverge. And the way that we would do that is simply just go and we would buy gold and we would sell silver. Now, what we have there is a situation where we're going to profit from rising gold prices and we're going to profit from falling silver prices. The beauty of this is maybe silver just doesn't do anything, but gold rises. That puts us into a winner. And then also maybe if gold doesn't do much, sort of maybe rises or stays the same, and the bottom falls out of silver, we're into a winning trade as well. So that's how you trade the gold-silver contract. Let's take a look at a few actionable strategies from historical data that can get you up and running in no time flat. Okay, here's some tendencies to watch for when you're actually trading the gold-silver ratio in the live market. Now, as you can see, when the ratio is high, we're looking to sell gold and buy silver. Why? Because silver's cheap compared to gold. So what we're going to do there is look for a ratio between 85 and 100, and essentially that's going to be sort of that position where you're selling gold and you're buying silver. Now, our historical average is right around 50 to 60. Now, we've seen in the last 25 years, our range essentially is 40 to 80. That average gets a little more streamlined as you take it out over time. 50 to 60 is a pretty good general rule of thumb to be using when you're trading the gold-silver ratio. Now, if the ratio is low, from 30 to 45, you're going to look to do the opposite of what we did when the ratio is high. We're looking to buy gold and sell silver. Now, why would that be? Because gold's relatively cheap compared to silver. Now, the idea here is that the ratio is always going to be seeking a point of equilibrium. That goes back to the concept of fair value. We talk about it each and every day in the live streams when we're looking at short-term charts. This is a longer-term chart, but it gives you a good idea of your baseline average and what you do when you're undervalued and when we're overvalued, and how you can play that back to sort of that reversion to the mean type of a strategy. Now, the gold-silver ratio is a fascinating concept. It's a fascinating indicator. It can be used in many different ways. If you're going to trade it directly, you go through those processes we just ran through over on our MT5. If you're looking for those historical tendencies, 85 to 100 means we're high. 30 to 45 means we're low. Our baseline value we're looking for is 50 to 60. All right, that's about all there is to it. Interested in trading the gold-silver ratio? Take it to the next level with metal CFDs at Switch Markets. Tight spreads, solid leverage, and execution that hits fast and clean. Backed by a reputable, globally trusted brokerage framework, you can trade with confidence and clarity. When you're ready to trade smarter, we'll see you at Switch.
The gold-silver ratio is a sharp, reliable pulse check on the metals markets, giving traders a quick read on where value may be hiding. It's also straightforward to trade. Just remember that long-term average, it sits around 50 to 60. So riding trends that pull back towards that zone is a powerful way to get in on the action. But nothing's guaranteed, so manage your risk and stay disciplined when putting this tool to work. All right, that's it for now. Like, subscribe, turn on your notifications, and we'll catch you on the next one.